Welcome to the Art of Money podcast with Art McPherson.
And this is the Art of Money podcast with Art McPherson and Luke McCarty, artofmoneyradio.com for more information on the McPherson Financial Group or to schedule that initial complimentary consultation. We appreciate you listening. Now, let's get to the show. Art, Luke, let's get to it because the world still talking about the bank collapses over the past couple of weeks. And, you know, the failure of some smaller regional banks have sent the financial world reeling. I want you to hear this clip from Mr. Wonderful, Kevin O'Leary, who says we're giving banks too much of a backstop.
This is going to be a political nightmare because you're going to have people saying, oh, we've got to keep all these small operators operating. But the big issue is if you nationalize the deposits and take the risk out of it. So if I'm an idiot manager in a regional bank and I'm compensated with stock, I'm going to put all of my depositors' money on black in Las Vegas.
No, that's right.
What I'm going to do. I'm going to either double it, and if it goes to zero, no problem for me. I don't have to worry about it because you're going to bail me out. The taxpayer is going to bail me out. This is very messed up. It's not a good situation. And I think Yellen's going to have a lot of trouble explaining this to taxpayers eventually.
Okay, I honed in on that. Yellen's going to have a lot of trouble explaining this to taxpayers. What does he mean by that?
Well, basically what you're doing is you are telling the banking system right now, by the way they've handled the SVB and the Credit Suisse situation, that whether or not you have done a good job as a bank manager, we are going to bail you out. There is going to be a backstop by the Federal Reserve and the government to make sure your deposits are good. Because if you look at the SVB bank situation, and I don't think we're done with that, but if you look at that, 97% of the depositors, which were about 3,000 people, had well over the $250,000 limit per account, right? Mm-hmm. So FDIC is only supposed to guarantee that $250,000. They're not supposed to guarantee $1 million or $200 million or $100 million because those people have that kind of wealth because they can afford it. But it's not guaranteed by the government backup. They're making sure that all of the money in there is backup and protected. So what you're now doing is you're backstopping more than the federal guarantee, and you're telling them, go ahead and take above normal risk with the money and with the deposits because we're going to back you up no matter what. That is not a good recipe for having stability. That is a recipe to have bad managers do even more aggressive techniques and more aggressive moves because, like he said, Mr. Wonderful, they're not going to be penalized for it.
Yeah, it's a slippery slope anytime there's a bailout or, the government stepping in because you're just adding more regulations to the banking industry. I understand the Fed need to come in and do something because you don't want the banks to spiral. You don't want to have a bank run. But, are we heading toward a national bank, right? The more of these small regional banks that go down for whatever reason, we can come up with any reason we want to for these banks that go down. Well, they're covered. And a lot of money right now is heading into the big four or big five banks. Mm-hmm. So we're kind of getting close to a government regulated bank, at least on the back end. And the problem that the Fed is having now is that they are increasing their balance sheet again. They're spending a bunch of money. They spent $300 billion last week. And so, before the panic of 2008, the Fed had about $875 billion on their balance sheet. Last week, $8.6 trillion. So when we think of these banks going under, think of all the reserves they have in the banking system. It's about $3 trillion. The Fed's paying them about 5% to hold those assets. So banks should be doing extremely well, making about $150 billion a year in free interest just to hold the money that was given to them from 2008. So to see one fail is horrible mismanagement from the bond side and not hedging the risk of, rising interest rates. Even though the Fed told us wrong, you still should have hedged your bet a little bit when you see rates rising.
Art McPherson, do you think we've seen the last of it? Or I know you don't have a crystal ball, or is this just the beginning and throughout the summer we're going to see more of these regional banks start to fall?
No, I think you're going to see more of it because right now there's no incentive for someone not to, right? So if you're a manager and you go out there and start taking more risk, if you bet wrong and all of a sudden you're going to have some negative returns and you can be like, oh, well, yeah, we're going to fail. Mm-hmm. Now we're going to get bailed out by the Fed. So I think you're going to see more aggressive actions made by some of these managers. So I think we're going to have more problems, not less. And you're basically rewarding bad behavior.
Yeah, I forget the number, but back in 2008 and 2009, there was about 400 bank failures. Most of them we didn't hear about because they were smaller banks. But if we're heading that direction, yeah, there's definitely going to be more, unfortunately.
Okay, 321-425-8550 to reach out to Art McPherson, Luke McCarty, and the team at the McPherson Financial Group. Also online, artofmoneyradio.com. Luke McCarty, if somebody gives you a call and they simply ask, Luke, is my money safe right now? How do you respond?
Depends where it's at and what you're invested in. But here with our clients, right, it's as safe as we can be while still being in the stock market. You know, we have some tools and some accounts that have the insurance side to them, have the safety, have the guarantees, but you can't have all your eggs in those baskets either. You know, looking at a market perspective, right, if the Fed does start cutting rates, now would be a good time to start owning fixed income in bonds again, which bonds got crushed last year. They lost money in 2021. They're kind of flat for this year, but if the Fed does reduce rates, we don't know if they will or how soon they will. You know, that's a good time to buy fixed income, but there's still risk in fixed income of the company going under or risk of default. So there's going to be risk in a lot of things you do unless you purposely seek out something that is risk-free.
Mm-hmm. Art McPherson, you know, there's a lot of people that have said over the past, year and a half that have a financial advisor, and they say, I have a financial advisor, but I felt like they haven't contacted me. I haven't heard from them. My needs aren't being met. Just out of curiosity, over the past week and a half, 2 weeks with these bank collapses, how often have you reached out to the clients? Are you putting videos out on YouTube? Are you sending out email blasts? What are you doing to offer a little bit of security to the families that you serve?
Yeah, we're going to be putting together an email here soon this week, just because of what's been going on and our take on it, where we think there's above average risk, where we think there's good risk. One of the things we do from a financial planning standpoint is, a lot of these short-term fluctuations of the stock market are based on different avenues or different things that create the environment. But it's still a negative cycle. It's still a cycle that we're going through. But we know in the future, we're going to have good cycles and we'll rally back and the market does what the market always does. But at the time that it's real, which is today, we address those issues. So how do we invest in today's world? How do we place our clients' money in secure assets and in safe type assets where they're not just getting crushed by all the volatility, crushed by all the noise, and that we're doing a good job for them and their portfolios?
321-425-8550. Again, 321-425-8550 or online at artofmoneyradio.com. And the administration, President Joe Biden, released his proposed federal budget for 2024. Its tax proposals clearly taking aim at Americans making more than $400,000 a year. Our paychecks may not be affected by this. We may not be making $1 million or more a year, but it's another reminder, Art McPherson and Luke McCarty, the importance of a tax strategy because Uncle Sam is coming regardless of how much we make.
Yeah, and it's not surprising because Biden ran his campaign on raising taxes and still got enough votes to win. But every time he gets a chance to talk about raising taxes, he does. Every time he gets a chance to talk about taking things away like the Roth conversion, he does. He may be the first president I've heard to talk about getting rid of the Roth conversion. He's the first president in a while to talk about raising taxes, but this budget is astronomical. What is $1.7 trillion or something crazy budget? And it talks about, raising taxes, for those making more money, but it also talks about the capital gains tax. If you raise the capital gains tax, right, the Warren Buffett bucket, if you raise Warren Buffett's capital gains above 20% to 39%, what do you think Warren's going to do this year? He's going to sell and capture 20%. So this could be a drastic big shift or big change from a stock market perspective if this new budget passes for 2024. There's a lot of tax planning you need to do today to avoid these tax increases. Even though it probably won't pass, we know the ideas and what they are trying to do, and they're going to come out bigger and then maybe scale it down a bit and come up with some agreement to raise some sort of tax.
It always frustrates me when the government comes out with their plans because typically there's a big difference between an economist and a politician. And what sounds good from a political standpoint does not make any sense from an economic standpoint. So as an example, politically, Biden had all of his executive orders he signed the first week of office, reversing a lot of the things that Trump had done for that 4 or 5 years prior. Trump was, did a lot of things, make America great again is how Trump called it, manufacture back in the U.S. and, kind of bring the money flow. But the bottom line is he inherited an economy that was growing at 5.5% GDP. Well, when the economy is growing at 5.5% GDP, you have a lot of tax revenue coming in the door. So even though Trump had lowered, quote, the tax brackets and lowered a lot of the taxes federally, it did spur economic growth. So we had a lot of economic growth, and the overall tax revenue coming into the U.S. Treasury had grown dramatically. Well, if you compare that now with some of the policies Biden has put into place over the last couple of years, we now have an economy that's grown at 0.5% last year. So we went from 5.5% the year prior to 0.5%, and now the expectation is another 0.5% year this year. So when you put all that together and you only have a GDP of 0.5%, I don't care if you raise taxes 15, 20%, you have a lot of less revenue coming in the door now because the economy is dramatically slowed. It's still less revenue coming in the door. So you could raise it 10%, 20%, 30%, you're still getting less revenue. So a lot of times these tax proposals that they're going to say, oh, we're going to have all this extra tax, it doesn't usually translate well from an economic standpoint.
321-425-8550 to reach out to our McPherson, Luke McCarty, and the team at the McPherson Financial Group to take a look at your tax strategy. It's something that a lot of retirees, they recognize it, but maybe they don't realize it until it gets put in front of them. We will continue to pay taxes. They're not going down just because we're not working.
Correct. You're still paying taxes. You're still paying sales tax. You're still paying property tax. You're still paying federal income tax. You know, maybe you're paying state tax if you live in a different state than Florida, but we're all still paying taxes. And, you know, the big thing, just to add to, you know, Art's explanation a minute ago, is we either have to raise taxes or reduce government spending. The government is growing a lot faster than GDP, especially now. But even during the times when things were better, the government's still growing too fast and spending too much money. And something needs to change, because I hate to go to the debtclock.org right now, but we're probably creeping on $32 trillion of debt. That is massive.
Well, remember when we had the whole subprime mortgage meltdown, Mark?
Yep.
And remember when the economy slowed and was barely growing, kind of like we are right now? Mm-hmm. Well, last year's growth of the economy was 0.5%. But did you know how much the federal government grew last year?
I don't know if I want to know.
I want to know.
Baseline 8%. Ooh. So the baseline growth of the government was 8%. Why did it grow at 8% if the economy is growing at 0.5%? And they do that every year. So when we went through 08, 09, 10, 11, and 12, and we had that whole subprime mortgage meltdown, and we had a dramatic, decrease in property values and across the board, and we had a very slow grow economy where everything was stuck in the mud for a 4 or 5 year period of time. The government was still growing at 8% per year. So the federal budget was growing at 8% per year. And there's no reason for that. So we have no check system or no restriction on the growth of the federal government, even though the economy, will grow and then contract and grow and contract. We don't have any of the same thing with the federal government. So the government either needs to be tied with the CPI or something where their spending is much more like real dollars coming into them, because they have just a, blank check, and now we're blank checking all the banks, and it's just crazy. It's just, you cannot do that. And everything that if we did in our business here and would go to jail for, the federal government can do, that should not be allowed.
Luke, I made the mistake. I went to usdebtclock.org.
What's the number?
31.6 trillion.
31.6.
Debt's
going up
per taxpayer, $246,868.
Yeah, see, that's money you owe that they spent. Some of that went to Ukraine for Ukraine's border, but we weren't allowed to put enough to President Trump for our border. So some of the policies that get out there, I don't always agree with them, but it's sometimes when we start spending our money that we owe debt for, and you or I don't really get to make a decision in that, and our representatives are no longer really listening to we the people, that's frustrating.
Thanks for listening. Want more from Art McPherson of McPherson Financial Group? Find us online at artofmoneyradio.com. We are an independent financial services firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Securities offered through World Equity Group, Inc., member FINRA and SIPC, a registered investment advisor. Investment advisory services offered through ProStatus Group, LLC. McPherson Financial Group and ProStatus Group, LLC are separate entities and are not owned or controlled by World Equity Group, Inc. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Past performance is not a a guarantee of future results. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Investment financial professionals are not licensed in all 50 states. Art McPherson is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstances. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Arthur McPherson, Florida Insurance License number A174725.
Today's show has been a work of art.